Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. European and US futures climb after the S&P notches yet another record ahead of earnings from Goldman and Citi. Meanwhile, oil tumbles on a Washington Post report that Israel will avoid targeting Iran's crude infrastructure when it hits back at Tehran. Bloomberg learns the US is weighing capping the sale of AI chips to some countries, broadening restrictions beyond China. And British Prime Minister Keir Starmer rejects the suggestion the UK is considering raising its capital gains to as high as 39% as he tries to calm investor jitters ahead of the budget. More from our exclusive interview throughout the hour. It's a big day for earnings. We look at, of course, to US banks. But before we get there, on the European telecoms equipment maker Ericsson coming through with the earnings for the most recent quarter, the third quarter. In terms of the numbers coming through, the headline numbers in terms of adjusted earnings, 7.3 billion Swedish krona. The estimates had been for 5.6 billion. So it's a beat in terms of the top line. Gross margin, we know the analysts have been scrutinising this. Also a beat for Ericsson, 46.3%. The estimates had been for just shy of 44%, and they see fourth quarter networks adjusted margins coming in at 47 to 49%. They have the deal with AT&T. We know that's going to be kicking in and has been kicking in the second half of this year. The stock, by the way, up at 29% or thereabouts a year to date. 24%, in fact, according to that chart, year to date for Ericsson. A beat on the top line when it comes to that telecoms equipment maker. We'll watch that, of course, at the open. Let's get back more broadly to these markets then. Yes, we had just another record from the S&P, the 46th so far of the year, powered by the technology share. So the lift coming through, the read across to Asia, a positive session so far. Mainland China, a little pressure there coming through. Volatility once again in terms of Chinese stocks. But again, the read across has been positive. European stocks then looking for the pickup, looking to add around 0.3%. Here in the UK, the FTSE 100 looking to add 32 points, up 0.4%. S&P futures after that fresh record looking to add 0.1%. And Nasdaq futures up 9 points so far in the session, essentially flat after the gains of yesterday. Let's flip the board and look cross asset. We've had some Fed speakers talking about caution, talking about patience in terms of the next steps for the Federal Reserve. The 10-year at 409. Euro dollar, a little softer then, down 0.1% at 108. We lead up, of course, to the ECB rate decision on Thursday. Brent at $75 a barrel, down a full 3% on that report around Israel's plans in terms of its retaliation against Iran. Gold at 2,642 per troy ounce, down 0.2% on the yellow metal. Let's cross over right now to Singapore. Avril Hong standing by for a check on the Asian markets. Avril.
Yeah, Tom, as you alluded to a short while ago, that positive handover from Wall Street is trickling through into the Asia Pacific, where we're seeing Japanese equities leading the charge after coming back from a long weekend. We're seeing tech cyclicals. Those are the stocks that are lifting the Nikkei past the 40,100 level. Levels we haven't seen since July, helped along by what we're seeing in investor sentiment ahead of earnings, but also the weakness overall in the Japanese currency. Back to levels we haven't seen since the August yen carry trade unwind, although the yen is firming a little against the greenback at the moment. Now, overall, we are seeing some of these stocks gaining ground, but there are a number of outliers, including on these energy stocks. Steep losses there against the backdrop of Brent, US crude futures sliding, but also as we mull some of these bits and pieces of information on China stimulus, including from the likes of Tyson reporting that China could raise as much as $850 billion via special bonds in order to kind of boost the economy. Meanwhile, we have a Bloomberg scoop that against the backdrop of these mega banks getting their margins squeezed, getting bad loans piling up, it seems that as soon as this week they could start mulling or announcing a cut to the deposit rates. We are seeing so far the investment community's reaction to stimulus efforts from China looking pretty mixed. A day ago, Goldman said, this is a turning point, but we have more recently the likes of Morgan Stanley saying steer clear of Chinese equities. Whatever's been announced so far part, not enough to fix things. And then don't forget also, they're flagging some of these tariff risks ahead of the US election. One thing is for sure, though, what we're seeing in terms of volatility, and it really makes you wonder the extent in which that is deterring longer-term investors on Chinese stocks. Also, as you see there, some of these Asian currencies are slumping. Certainly a gauge of them is on track for its worst month since February 2023. Some of this explained by what we're seeing in the yuan weakness, which accounts for a large part of the gauge, but also the dollar story. This month, we've certainly been seeing that recalibration of Fed expectations, Tom.
Ava Hong joining us out of Singapore with a deep dive on the Asian markets. A lot of lines to work through there then as we look at the impact. Ava, thank you very much indeed. Let's switch focus to the Fed then, because we have been hearing from a number of Fed speakers. Governor Christopher Wallace saying that recent economic data signals policymakers can approach future cuts with less urgency than their meeting in September.
This scenario implies to me that we can proceed with moving policy toward a neutral stance at a deliberate pace. This path would be based on the judgment that the risks to both sides of our dual mandate are balanced.
OK, for more on this, let's bring in Bloomberg's Valerie Titareva. Valerie, you cast our minds back to September, the 50 basis point cut from the Fed. It felt like they were racing towards maybe an end line, a crossing point, possibly far into the future. Now they're pulling on the reins a bit in terms of this race around the cutting cycle. What do you make of the Fed speak?
Look, Waller sounded a bit dovish to me yesterday. You have to remember that we just got a hot string of data out of the U.S. and market watchers are very much looking for any hints of a hawkish narrative or a hawkish spin. We definitely didn't get that from Waller yesterday. He was talking about the economic conditions currently warrant cutting at a deliberate pace. We also heard from Fed's Kashkari yesterday. He's not worried about the upside risk to inflation either. He said there is a lot of evidence to suggest that inflation is going to continue to fall from here. So far, this string of hot economic data not yet changing the Fed's message.
And as we mentioned, stocks, the S&P hitting another record. I mean, they just keep tumbling, 46 so far year to date, Valerie. What is powering the further upside? And given what we're hearing from Fed speakers, can we just assume that there is further runway for these stocks?
Listen, Tom, if you take into account that the Fed is going to continue to cut through this hot economic data, that sounds like some loose financial conditions to me. And the S&P futures and the broader equity market seems to agree with me. In the last 2 days, we've gained nearly 1% on the S&P. It notched another record gain. But yesterday was a lot more driven by the tech space. We had a record high from Nvidia. If you flip the board, we can just see how much this Nvidia stock has risen over the last year. It has now risen over 200% in the last 12 months. It's notched its first record since June and looks to maybe add on that today.
200% in 12 months. There you go. Valerie Titareva, thank you very much indeed on Fed speak and what we're seeing across these equity markets. Now, Bloomberg has learned that the US may cap sales of AI chips to certain countries. The move could limit AI capabilities in places like the Middle East. For more on our exclusive reporting, let's bring in our tech reporter, Annabelle Drewler, standing by for us. Annabelle, why is the Biden administration looking to these measures? It seems month after month there's an adjustment from Washington in terms of their restrictions, and now we have details on further restrictions, particularly around these AI accelerators.
Yeah, that's right, Tom. And again, to your point around sort of these incremental developments, it's all sort of based, at least for this story, around the validated end user program or the VEU program that's in the US. And this is a mechanism that they use to restrict exports of certain high-tech or high-end technology to places like China and India. So last month, the VEU program was expanded to include data centers, and today the reporting that we have says that this could be expanded even further to restrict exports of certain AI chips to places like the Middle East in particular. The focus on the Middle East for a couple of reasons. Firstly, you've got not only a region that's very much focused on building out its AI capabilities, you've also got a region that's very deep pockets, so it has the capacity to fund those ambitions, and also one that's got a growing relationship with China. And that really speaks to the broader concern, of course, we're familiar with, that the US is looking to restrict China's advancements in this area in particular. And the concern is that if exports of chips from the likes of Nvidia, AMD, Intel can continue to these third-party countries, they could still make their way into the mainland.
Yeah, we know that there are Chinese buyers, certainly in the mainland, with ingenious ways of getting hold of these Nvidia chips. Talk to us about the potential leverage play that the US is thinking about. They have this key technology. Can they use it? Will they use it? Are they planning to use it maybe as diplomatic leverage in the future?
Yeah, it certainly becomes a sort of tool in the bargaining process. I mean, we know, for instance, that companies could be asked to reduce ties with China, for instance, in order to access that US technology. I mean, it's one of the ways that they can sort of look to apply pressure, is particularly to those countries or regions that have been friendly toward Beijing. The US also doesn't really want to risk falling behind either. That's another concern in this, because you've got that question over, if you have exports of that advanced technology, could it be used by countries to then develop applications that could be used against the US in turn? So that's another question. Of course, the concern is, how will AI chip makers respond to these restrictions that could come into force? We've already seen Nvidia, for instance, responding to the export restrictions to China, sort of tweaking some of the most advanced infrastructure to allow it to fall beneath the restrictions that are in place. But certainly, if the US or the White House is to move forward with these sorts of caps, it's going to really put its different relationships in play. It could put a little bit of tension into them, and also something that might be difficult to enforce before President Biden's term ends just in a few months from now.
Yep, the politics ever present in these decisions. Bloomberg's tech reporter Annabelle Drillers, thank you very much. Here's what else we'll be thinking about today then on the economic data front here in the UK. 7 a.m. UK time, we're going to get the jobs data. So we'll bring that to you live. Of course, markets are pricing in a cut from the Bank of England in November. Less certain, though, as to whether or not they go again in December. The jobs picture could tie into that decision making. Later today, of course, we had JP Morgan on Friday. Later today, we get earnings from Goldman Sachs, Bank of America and Citi. We will, of course, break those for you and give you all the context. And after the market, we're going to get sales from LVMH. To what extent is that luxury goods maker still facing the China challenge? That story as well in focus. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go, and front and centre on today's coverage is the story around additional restrictions on those AI chips. Coming up, oil slumping after a report that Israel will avoid targeting Iran's crude infrastructure and instead focus on the military. We bring you the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Oil under pressure so far in the session. Brent down 3.7%, back below $75 a barrel. WTI just above $71, down 3.7% as well. This on reporting from the Washington Post that Israel's Prime Minister Benjamin Netanyahu has told the White House he is willing to strike Iran's military rather than those oil or nuclear facilities. Let's bring in Bloomberg's Horizons Middle East and Africa anchor, Jumana Pasechi. Jumana, what does this mean then for tensions in the region? How seriously should we take this reporting? How much clarity do we have on Israel's potential decision on this issue?
Well, lots of questions there, Tom. Let me just start with, we don't have a lot of clarity on what Israel are expected to do, but what we do know is that there have been extensive discussions within the security cabinet, but also with the U.S. as well. Washington Post echoing a similar report that was put out by NBC last Friday, suggesting that they had reached an agreement over Israel limiting their strikes to military infrastructure as opposed to going after oil infrastructure, which could cause significant upheaval in some of these oil oil markets. And the more nuclear option, of course, would be going after nuclear facilities as well, which was also one of the concerns that people had raised. But what is clear from all of this is that there have been active discussions taking place between the U.S. administration. And of course, they're keeping an eye on the upcoming U.S. elections. They do not want to see a huge tumult in the price of oil. But at the same time, the U.S. have also done their bit by doing two things. The first is, we spoke about this yesterday, supplying Israel with this sophisticated missile defense system called THAAD. We spoke about it yesterday. It's expected to be operational in coming days. And the second element is that also this went under the radar, but on Friday, U.S. also announced further sanctions that would pretty much hit all of Iran's oil industry. Goldman Sachs estimate that could hit about 1 million barrels a day if indeed these sanctions are enforced. And therefore, it seems as though the approach here is, yes, Israel will definitely strike back Iran in some shape or format, but it is alongside further defense capabilities coming through from the U.S. and sanctions being applied to Iran as well.
OK, so we talked about the fact that this reporting has, of course, put pressure on the oil markets. What have been the other drivers of oil in the last 24 hours or so, Jemana?
Well, you see what's happening with the price of oil this morning, down 3%, and not just on back of this Washington Post stories. There were several other drivers as well. You go back to the fundamentals, which is China. China demand signals once again showing some weakness there. There were oil imports. The data came out showing weakness for the fifth month in a row, year-on-year declines as far as oil imports are concerned. And China, of course, as we know, is one of the largest oil-consuming nation in the world. In addition to that, OPEC Plus revised downwards their demand growth forecast into next year. Now, OPEC Plus tend to be on the more optimistic side of the spectrum. They tend to overshot vis-a-vis other think tanks out there, but they have revised down their outlook for the third month in a row. They now see the demand growth totaling 1.93 million barrels a day for this year, 1.64 million barrels a day for next year. Just to give you context here, other think tanks are saying that it will be closer to around 1 million barrels a day. So they're still much higher than what the market is penciling in. So you are looking at a mismatch here between supply and demand in an environment where OPEC Plus are signaling that they're still going to start putting oil barrels back to the market in the fourth quarter of this year. But then on the flip side, Tom, we talk about these further sanctions on the Iranian oil exports. So if those do come to pass, then they could exert a bit of upward pressure. In addition to that, we talk about some of the further geopolitical tensions that could emanate should this regional conflict get bigger than it actually is. So there's still some potential for supply disruptions, but overall, what we're seeing this morning is the fundamentals continue to weigh.
OK, Jemana, thank you very much indeed. And yes, we will continue to watch the detail on those potential additional sanctions on Iran and indeed whether or not they are implemented. Jemana Besetchi, of course, our Horizons Middle East and Africa anchor on the latest out of the region. Coming up, why German car makers are getting left in the dust by Chinese EV makers in their biggest and most lucrative market. We're going to look at their challenges next. This is Bloomberg.
We need to find a deal with China, okay, and we need to get used to a form of co-opetition, or that means basically on the one side you compete, on the other side you cooperate, as actually they did with us when we went 25 years ago in China to take also advantage of the Chinese market.
Renault CEO Luca De Meo speaking to Bloomberg's Oliver Crook at the Paris Motor Show. And car makers have indicated that demand for electric vehicles is picking up as prices come down. Bloomberg's Oliver Crook joins us now from Brussels. He's been covering, of course, this event for us. Ollie, talk to us about what you've been hearing from Chinese brands, how they're thinking about this European market. I know you've been speaking to a number of executives over the last few weeks and on the ground about how they're approaching a market where they are now facing these significant tariffs. How are they adjusting?
Yeah, Tom. So listen, you really struck when you're at the Paris Auto Show by just how crowded the space is. I mean, we talk about Stellantis, for example. It itself has 15 brands. And now you really get a challenge of just overcapacity within the market in terms of all these brands with the Chinese automakers really coming in. And really you get the sense from them, despite the tariffs, that they're not really slowing down basically at all. They're still waiting for the sort of final word on the tariffs. There is still a little bit of room for negotiations. But even if those tariffs come in full as they have been proposed by Brussels right now, they're not going to slow down at all. For them, this is an absolutely key market. It's their main growth market outside of China. We know that they're never really going to be able to touch the U.S. market with the current regulatory framework. What I think is interesting is how they go about doing it. For example, Stellantis has partnered up with Leap Motor. And what is very interesting about that partnership, Tom, is they've basically inverted the German model from the 1980s, what happened in China, where the Germans basically set up a joint venture that they own a sort of proportion of it and then start building cars for the market. That is exactly what Stellantis is doing with Leap Motors. And when we spoke to them, we started to get a timeline for when they're actually going to start building these cars in Europe. And that's about a year and a half away. That is one of the most concrete timelines we've gotten them from them so far. But Tom, what I think is really interesting is the difference between that then and here now is that China did not have a car industry back then. The Europeans certainly do, and it's a huge part of their economy, which is why this is such a sort of poignant point for the European policymakers.
Yeah, so look, as you suggest, as we know, it's about Chinese competition, but it's also about that demand around EVs and whether or not that is starting to bottom. Have you picked up on any sense, any reason why there may be cause for optimism in terms of EV demand?
So listen, Tom, what I thought was really interesting about this felt very much like an EV show for a place where people don't really want EVs that much, right? We've seen that within the market, within Europe, where you just haven't had the demand there. Where the rubber hits the road, I think, for these car makers and for also consumers, is that next year you have new policy coming in from Brussels that basically dictates that these car makers need to sell about 1/5 of their cars, 20% of their cars need to be EVs in order to not get hit with literally billions of dollars or euros worth of fines. Right now, that's stuck at about 15%. So we spoke to Carlos Tavares basically about how do you adjust what policymakers want versus what the market wants. Here's what he had to say.
Right now, we only ask two things to the governments, and specifically the European governments. We ask stability of the rules. We do not ask for any kind of postponement because we are ethically committed to contribute to fixing the global warming. So we don't ask for any postponement. We ask for stability from one side. And from the other side, we ask the governments to stimulate the demand, which is not to help Stellantis, but to help the consumer so that the consumer can buy EVs at an affordable price.
And so listen, Tom, from what we heard from the executives there, they're starting to see a little bit of optimism for demand coming back. Remember, these EVs are a lot less expensive than they were 1-2 years ago. Is it enough to call it a full recovery? I think it's a bit too early to tell, Tom.
OK, Oliver Crook, thank you very much indeed on this European auto market, how it's adjusting to Chinese competition and the ebbing but maybe returning demand for EVs. Ollie, thank you. Coming up, following a rocky 3 months in power, UK Prime Minister Keir Starmer pushes back against capital gains tax speculation. That exclusive conversation is coming up next. It's not going to be as high as 39%, though didn't land on a specific number. Pushing back and trying to assuage those investor concerns about whether or not the UK is still a bright prospect for investment. Also his views, of course, on how to achieve the elixir of growth for this UK economy. That is coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. European and US futures climb after the S&P notches another record. That's ahead of earnings from Goldman Sachs and Citi later today. Meanwhile, oil tumbles on a Washington Post report that Israel will avoid targeting Iran's crude infrastructure when it hits back at Tehran. Bloomberg learns the US is weighing capping the sale of AI chips to some countries, broadening restrictions beyond China. And British Prime Minister Keir Starmer rejects the suggestion the UK is considering raising its capital gains to as high as 39% as he tries to calm investor jitters ahead of the UK budget. More from our exclusive interview just in the next couple of minutes. Let's check in on these markets then. Yes, a 46th record for the S&P yesterday, powered by the tech story, semiconductors, chip makers, all leading these gains. Nvidia up around 200% just in the last 12 months or so. European futures currently pointing higher by 0.2%, looking to build on the gains of about 0.5% yesterday for European stocks across the benchmark. FTSE 100 futures currently pointing up by 0.2%. There's a bit of pressure on the commodity space this morning with the focus on oil. S&P futures currently flat, as are Nasdaq futures. Let's flip the board and look cross-asset. Then we've been hearing from Fed speakers, including Christopher Waller and Neil Kashkari, suggesting there is room for further modest cuts and caution, a deliberate pace. That's the language coming through from some of those FOMC officials. 408 on the US 10-year, 108. Bit of pressure coming through on the single currency. Currently down 0.2%. The ECB decision, of course, on Thursday, expected to cut $74 a barrel on Brent, down almost 4% so far in the session. And gold also off by 0.3%. Now, UK Prime Minister Keir Starmer has rejected the suggestion his government was considering raising capital gains tax to as high as 39%. He spoke exclusively with Bloomberg as he tries to calm those investor jitters ahead of the budget, of course, at the end of this month.
All of the discussion today has not actually been about tax. It's been about planning. It's been about the regulatory environment. It's been about getting infrastructure moving much more quickly and the sort of apparatus of government working to that common end. That's the real discussion that's going on here. That's the real focus. And actually, contrary to perhaps what people might think, tax is not the first thing that businesses and investors are raising with me. The first thing they're raising with me is it really your number one mission? Is it going to be stable and strategic and for the long term, to which the answer is yes? And are you prepared to do the tough things on execution and the deliverables, which is about, the length of time it takes from investment decision to actually seeing a project materialise? That's where I think we've been able to do a lot of reassurance that, yes, we understand that, and we're determined to do the follow-through on growth that is desperately needed for investors, for our country, and for the jobs of the future.
Forgive me, Prime Minister, but I think a lot of people, they may not be talking about it to you, but a lot of people are worried in this sort of vacuum that we've had, quite a long wait for the budget. There's quite a lot of what might be just crazy speculation around where capital gains tax might go, for example. So something like a 39% rate. Can you reassure people that whatever the change is, it won't be anything that significant?
Well, quite a lot of speculation is getting pretty wide of the mark. But
so you say that 39 is wide of the mark?
It's getting to the area which is wide of the mark. But I'm not going to fuel the speculation because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget.
OK, the UK Prime Minister, of course, Keir Starmer, speaking exclusively with Bloomberg's head of economics and government, Stephanie Flanders, yesterday. Right now, very pleased to say we're joined by Anna Titareva, European economist at UBS Investment Bank. Anna, good morning. Thanks for joining us in the studio. Let's start on the UK then, and what we've been hearing from the Prime Minister, pushing back on that 39%, talking about the budget, and the build-up is certainly there to the end of the month, and the details around the fiscal steps of this government. To what extent should markets, should investors be pricing in a more fiscally constrained UK government after this budget?
Yes, so when we look at the upcoming budget, the government is facing a very challenging situation where we know that spending is on track to be around 22 billion above the expectations back in March. Also, in terms of the starting point, in terms of fiscal headroom, it's already very tight. It was tight in March, and situation probably now has gotten even tighter. And of course, the government is expected to announce some more plans in terms of investment projects, infrastructure projects. So against this backdrop, we do think that the government will essentially come up with a package of both tax increases, but also, importantly, some changes to the fiscal rules, which should mechanically increase some fiscal headroom and give them more space for spending.
That's interesting because, of course, they continue to push the mantra. They need to have that fiscal discipline. They pointed out this fiscal black hole. There's a little bit of controversy around that number. But you're suggesting that the markets are willing, potentially, to allow this government to borrow a little bit more, to have a little bit more headroom in terms of the borrowing, and that will not be punished by these markets.
Yes, so what we've seen in the last few days, markets are getting a bit nervous in terms of spending, getting a bit out of control. But when we look back at the election period, we've seen a very strong focus of the Labour Party on fiscal prudence. And against this backdrop, it seems that the markets are willing to give a bit more space to the current government.
OK, so we layer on top of that the Bank of England. The markets are pricing in another cut, 25 basis points in November. There's more uncertainty about what they do in December. There are fewer than 2 cuts priced in by the end of this year. Where do you line up in terms of your expectations for this Bank of England? Is it setting itself up for a policy mistake by not going with more deeper cuts at this point?
Now, if we put the Bank of England in the context of the ECB or the Fed, their stance does look relatively more hawkish. Our baseline is that they deliver just one more rate cut this year, so in November, then pause in December, and then go relatively gradually in the first half of next year, and then speed up the pace of cuts in the second half of the year.
Why the caution? Why just one more this year? And is that a risk for this economy?
Well, when we look at the inflation dynamics, at the labour market dynamics in the UK, we are seeing that services inflation in the UK is higher, is a bit more sticky than what we anticipated going into this year. Labour markets are also quite tight, and there is one very UK-specific issue in terms of labour market tightness: the fact that labour participation rates remain low, and we are not seeing people coming back to the labour force quickly enough to ease this labour market tightness. So we think this currently justifies relatively slow and hawkish pace of rate cuts from the Bank of England. But of course, we are monitoring sort of spillovers, negative spillovers in terms of growth, in terms of potentially quicker easing in terms of labour market tightness.
So before we move on to Europe and the ECB, your projection around UK growth into 2025?
Yes, so we recently upgraded our forecast, so we expect 1.1% growth for this year, and then we left our growth forecast for next year unchanged at 1.5%. But given the recent indications from monthly GDP and also recent national accounts revisions, we do flag some downside risks to our growth forecast.
OK, downside risks to that 1.5% forecast for UK growth for next year. On the ECB, then, our own opinion columnist Marcus Asworth has said the ECB on Thursday should go with a bazooka-style cut of 50 basis points. All the data, he says, on Europe is flashing red. Do you agree?
So our baseline is that they go with a smaller 25 basis point rate cut. We do think that the bar for them to deliver a 50 basis point rate cut is relatively high. And again, when we look at the last ECB meeting, we've seen sort of comparing what happened in between the last and the current ECB meeting, we see 3 sort of changes. One is that data on the growth side has indeed been somewhat worrying. We've seen clear signs of loss of economic momentum. Inflation has showed signs of a slowdown. We got 1.8% print. That's the first below 2% print since June 2021. And of course, we've seen some comments from the Governing Council members where they are indicating growing confidence in terms of wage growth deceleration and ultimately slowdown in services inflation. So all of that does indicate that they are willing to cut, but we think that they will continue in a gradual mode of 25 basis points.
Will that be enough to pull Europe out of its economic funk?
Well, in terms of our growth projections, we actually cut our next year's forecast recently by 30 basis points to 0.9. So we have turned somewhat more cautious on the growth outlook. However, we do, stated very clearly, we're not turning outright negative, relatively cautious.
Yeah.
But not.
Sub 1% growth for the Eurozone next year, 1.5% for the UK is the forecast right now. Anna Titareva, thank you very much indeed. As we lead up, of course, our ECB decision on Thursday. Anna Titareva, European economist at UBS Investment Bank. Now, to some other stories making the news this Tuesday. Bloomberg understands that Italy's government is targeting €4 billion from firms by adjusting tax thresholds and removing certain tax deductions. The move is an effort to help plug a €9 billion budget shortfall. The €4 billion figure is included in draft proposals under discussion in the Finance Ministry, and nothing has yet been decided. China is said to have started enforcing a long-overlooked tax on overseas investment gains by the country's ultra-rich. Sources say wealthy people in major Chinese cities have been told to conduct self-assessments, while tax authorities have summoned others for meetings. Beijing is looking to expand its sources of revenue as land sales tumble and growth slows. We are just 3 weeks away from the US election. It's come around quickly, hasn't it? And right now, the race for the White House is too close to call. Former President Donald Trump will be sitting down with Bloomberg editor-in-chief John Micklethwaite later today. Here, with what we can expect, is opening trade anchor Kriti Gupta. Kriti, thank you for joining us on set ahead of your show, of course. Talk to us about where the polls stand and what to expect. How have things lined up for both candidates? And what are we expecting to hear from Trump?
Well, the latest NBC poll shows neck and neck. In 3 weeks, 21 days to the election, as you mentioned, no surprise there. Even though we are coming off of other polls just 2 short weeks ago where Kamala Harris showed a national lead of about 4 points. So you can kind of see the fear behind the scenes that perhaps in the campaign for Kamala Harris, some of that early momentum you saw in the summer, that kind of social media momentum, perhaps fading off just a little bit. Again, anything can happen when it comes to this election. But in the words of the famous James Carville, it comes down to the economy. It's the economy, stupid, right? And it really comes down to this idea of tariffs. And I think that's what's going to be the key piece of perhaps editor-in-chief John Micklethwaite's interview with Donald Trump today. Talk about what the economic plan actually looks like, because that's where things are a little bit hazy. Of course, he's threatened tariffs on China, threatened tariffs on the rest of the world, pulling defense spending for NATO. But then if you look at the Harris plan to compare as well in terms of the economics, all we've really seen is a capital gains tax increase to about 28%. So an increase similar to what we saw of President Biden, although not to the same extent. But then also talking about this idea of addressing prices, whether it's groceries, whether it's housing, really increasing some sort of price controls. Of course, economists saying that neither plan is necessarily healthy for the American economy or the global one. But at the moment, clarity around the tariff story seems to be what's most relevant for the rest of the world.
OK, Kriti Gupta, thank you very much indeed. Anchor, of course, on the opening trade. And you can watch Bloomberg editor-in-chief's John Micklethwaite's exclusive interview with Donald Trump, 5 p.m. London time. So certainly tune in for that interview. 5 p.m. London time. Let's check back in right now on the oil markets. This is the asset class seeing the biggest moves right now. Brent trading, as you can see, down 3.8% so far in the session, below $75 a barrel. 3 straight days of losses right now. WTI at $71, down 3.8%. Largely, it seems, on the back of this Washington Post report that Israel has signaled that it will not be striking Iran's oil infrastructure when it does retaliate, though Bloomberg reporting suggests that Israel has said it is keeping its options open. So we continue to monitor the oil markets. Part of the other side of the story as well is the stimulus out of China, and the lack of details maybe as well proving something of a headwind for these oil markets. We'll keep across for you, of course, this story as it evolves. Coming up, we're going to take the temperature of the venture capital scene here in the UK with Simon Bumfrey, Head of Technology and Life Sciences at HSBC Innovation Banking UK. That is next. This is Bloomberg. Welcome back. Now, here in the UK, as we've been hearing, it's been a big week, of course, with the investment summit taking place in London. We've been speaking to the Prime Minister, of course, about his attempts to continue to lure in that investment. Elsewhere, a new report by HSBC Innovation Banking UK highlights how venture capital firms are splashing their cash and funding the health tech and life sciences sector. Why are they doing it? We are joined now by Simon Bumfrey, who's the head of technology and life sciences at HSBC Innovation Banking UK. Simon, thanks for joining us. You saw some of the stats there on the screen. So it seems like the funding is there right now for health and sciences, the biotech part of the UK ecosystem, which is certainly one of our strengths. What are the numbers? What is the deal flow telling you and the team about the appetite for investors and where they're putting that cash to play?
Yeah, there's two ways of looking at it, Tom. There's the actual deployment of the capital. And if you look at the figures year to date, the UK has invested just under 13 billion, which is tracking against the last year, 2023, and also the years of 2019 and 20. And obviously, they had the outlier years of 21, 22, etc. So we're in a pretty good place. And then the second point is around the actual capital raisings themselves. And if we look at the data in the deal room report, what it's telling us is that 9 billion has been raised year to date, and it's on a trajectory to hit probably around about 12 million. And if that was the case, that would be actually a record year of raising funds, even surpassing 2021. So when you take that into consideration, it feels like we're in a pretty good place at this moment in time.
Okay, so 9 billion to 12 billion, to be clear. So potentially 12 billion, and that would obviously be kind of significant in historical terms, going back to 2021. Which parts of the health and biotech ecosystem are attracting this level of funding? How does it break down?
Yeah. I mean, the UK is really setting itself up as a world-class hub for life sciences, and we're seeing that.
That's not hyperbole.
No, that's actual.
Yeah.
And 4 of the largest VC fundings this quarter were actually in the life sciences sector. So we had 3 in biotech. There was Myrix, there was Vice Bio, and there was F2G. And then the largest round was actually in health tech, into Flow Health, which is a female technology looking at fertility app. So it really sets up and demonstrates how strong the life sciences sector is.
The challenge for Europe has been the growth stage funding. So how much of this is the early stage of the funding cycle, and how do we sit here in the UK in terms of that growth part? Are we still lacking that component to get the scale that we need?
Yeah. When I looked at the data, what I'm really excited about is the kind of breakout stage, let's call it, those in Series BC. So it's those companies that have just come out of that fresh early stage and into the next level of investment. And that's really important for the UK economy. It's the kind of jam in the middle of a sandwich where you need to get that investment. You get a different level and size of investor that really does take those businesses to another level. So I'm really excited about that particular stage. And in terms of the growth stage, the scale up that you alluded to, what we're seeing is 70% of the investment year to date is from overseas investors. Now, I don't think that's a bad thing, okay? We need investment to take these businesses so that they grow and become kind of world-class global businesses. So I'm particularly excited about the future.
Well, it points to that foreign interest, and I know a lot of that funding is coming from the US.
Yes.
So, yes, that ticks a box, right? But in terms of, it also signals there's not enough investment coming through from the pension funds and investors here in the UK. How do we change that dynamic?
Well, it's being looked at. I think the appointment yesterday, or the recent appointment of Poppy Gustafsson, is a real positive.
As investment minister.
As investment minister.
Formerly at Darktrace.
Exactly. Having scaled up a business herself and then taking it through a public offering, I think that's a really good high-profile hire for the government, and also to help guide a framework of policy to attract that further investment, so we can really look to scale up these businesses at the higher end. And again, we've heard about the mansion house policies and attracting pension insurance funds. So we seem to be talking about the right things. I think it's the actioning of this as we go forward.
It's the implementation, isn't it?
Yes, absolutely.
When you speak to your clients and venture capital, what is the sense that you're getting in terms of the founders and the investors about the exit environment? The capital markets are still pretty frozen. here in the UK, Europe, the US as well, to some extent. Are they relying on takeovers at this point? Are they relying on acquisitions as the exit mechanism?
Yeah, we've been through a kind of 2-year hiatus, really, in terms of exits. Now we're seeing more capital being deployed and into the sector. So those companies that have been through that 2 years, they've got themselves in order in terms of their cost base, and they're now looking around the future. What is their exit policy? And I believe what we'll see is a lot of M&A activity going forward that will be the exit. And I think that will happen ahead of any uptick in the IPO market.
Are your clients worried about tax increases from this government?
I speak to clients and investors every day, and they're very interested in what the budget's going to tell us on the 30th of October. What I would say is that they're very interested that any change does continue to attract investment into the UK.
Okay. Simon, thank you very much indeed. Joining us bright and early in the studio, Simon Bumfrey, Head of Technology and Life Sciences at HSBC, Innovation Banking UK. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We look ahead, of course, to the earnings when it comes to the banks out of the US, with Goldman Sachs and Citi reporting later today. The focus in some part of the earnings story is to what extent you may get an earnings beat from the S&P stocks X the Magnificent Seven. So the S&P 493. They actually beat in the last quarter, but expectations have been cut. The blue bars, that is the Mag 7. Those expectations are still pretty solid. When it comes to the S&P X the Mag 7, though, those expectations around the earnings story and revisions, they have been edging lower. To what extent does that change when it comes to the details of the earnings story this quarter, and will it fuel that rotation into other parts of that market? So that's worth thinking about as we build up to the earnings season and walk through the banks later today. Let's flip the board and have a look at what's happening in terms of the Trump trade. Yeah, predict it. And the prediction markets are suggesting that Trump now does have a lead, and you're seeing investors reacting to that, getting to exposure to some of those Trump-linked stocks, or at least stocks that many expect may benefit from a Trump presidency. Regional banks, for example, energy stocks, crypto-linked stocks. And this is the Goldman Sachs. They have two baskets, one focused on stocks that may benefit if a Democrat wins, Kamala Harris, of course, and one that would benefit if Trump would win. And the moves into the Trump basket have been there, as you can see, with the blue line ticking up, the white line for Kamala Harris, and those Democrat-linked stocks edging lower. The polls, of course, suggest that Kamala Harris has a slim lead. Bloomberg Terminal subscribers can get access to these charts and others used throughout the show on GTV Go, by the way, on the Bloomberg Terminal. Later today at 5 p.m, we will be speaking to President Trump, speaking to Bloomberg exclusively to our editor-in-chief, John Micklethwaite. So tune in for that, 5 p.m. London time. The opening trade is up next. This is Bloomberg.